All right, everybody, we have started recording the call, so take due notice thereof, govern yourselves accordingly. This is going to be a call about depreciation schedules in general. We're going to talk about accelerated depreciation. We're going to talk about on a sale what depreciation recapture means. And as always, we are not your priest, your lawyer, or your accountant. So if you like what we say and you're gonna use it in your real life, go out and also get your own professional advice. In other words, if you hear something from us, you go out, you do it wrong, you can't sue us. Not that some folks wouldn't want to try. Right, Michelle? That sort of a thing. Um, all,
Possibly.
yeah, all kidding aside, guys, thank you for joining the call. We're going to be talking about depreciation a little bit. I'm not sure if everybody knows what depreciation is, um, but is there anybody have any specific questions, or is there anybody that's not really sure what depreciation is? All right, well, let's start with some basics. When you go out and you buy a building, and we're going to talk specifically about real estate, although this does apply to other things, but we're going to talk specifically about real estate. When you go out and you buy an investment property, you've got a lot of cash expenses, right? So you get income in from a tenant, and then you've got expenses, things like paying the property taxes, Justine's in the call, so paying your property manager, paying the utilities, whatever it is, you're going to have some expenses associated with it. So let's say you buy a property for $100 and you get, let's say it's $8 a year in rent. After those expenses, you're going to end up with $6 and you will pay taxes on that $6. Those are your cash expenses. Depreciation is what's called a non-cash expense. So it's an expense you can take that will shield your income from taxes, but you're not actually writing a check for it. And the concept is if you have a building, it's got sort of a life expectancy before the building's gone, and you get to write it down over those years. So I'm going to share my screen with you guys. Uh, all right. I'm going to go over to I don't know, I didn't want to move. Okay, so I'm going to assume a couple of things and then get into it. Let's say you buy a property for $1 million, okay? And that property, after expenses, after your cash expenses, has a net income of $85,000 a year. Let's further assume that the rent is going to go up by 3% a year. And then when you get your land card, there's other ways of doing this. You can do it with an appraisal. The way that most people do it is they get their property tax record or their assessor's card or their land card, and that will break down the value of the building or the property that you bought. It'll give a number for the land and a number for the improvements, and you can back into that and create a percentage. So to keep things simple, let's say we bought again, we buy a building for $1 million. I get my assessor's card, which you used to have to go in and do it in person. Now you just do it online in 3 seconds. And the assessor's card, which by the way won't say $1 million, it might say 450,000. That might be the assessed value. Um, Assessed value is not market value, people. It is not the same thing. But let's say it said 450,000 and it said 225,000 for land, 225,000 for improvements. That's 50-50. Okay, so that's the numbers I'm using. 50% land, 50% improvements. So that means my depreciable base, the number I can use to start this whole depreciation calculation, is 500,000. 50% of the $1 million. You might say, well, what's that? Why is that my number? The concept is land never depreciates, right? The building you put on the land is only good for so many years, but the land itself doesn't depreciate. And when you say for so many years, the IRS has said that residential, which includes apartment buildings, is supposed to last for 27 and a half years. And commercial properties like a warehouse building or an office building are supposed to last for 39 years, right? So I think we all know plenty of apartment buildings that are older than 27.5 years, and we know plenty of commercial buildings that are older than 39 years. But for purposes of this discussion, we're just going to use the IRS schedules. And very few of us are multifamily brokers, so I'm going to use the commercial schedule. I'm going to take a second here and tell you there's another way you might run into this. If you buy your house and you're using part of your house as a home office, you can get a deduction every year, a depreciation deduction every year on a portion of the house that you use for business. And it's going to use these schedules. When we get into depreciation recapture later, I'm going to tell you and kind of really explain to you why that might not always be such a great idea. But okay. So far we buy a property for $1 million. We get our land card. We determine that it's 50% land, 50% improvements. We can only depreciate the improvements. And so our depreciable base is 500,000, and the IRS says I can depreciate that over 39 years. What does that mean? That means I take that 500,000, right? So I take this and I divide it by 39, and every year I can take a write-off, a deduction, an expense of $12,820. That works out to a little over $1,000 a month, by the way, if you only have the building for a partial year. In our discussions, I'm going to assume you're in California, and I'm going to assume you make a lot of money. So if you're in California, the top ordinary income rate is 13.3%. The top federal rate is 37%. So you could be paying as much on ordinary income as 50.3%. And I think there's actually ways that it goes higher than that, but that's what I'm using just for the examples. And then on the capital gains side, California treats ordinary income and capital gains exactly the same way. So that's 13.3% in the top bracket. But your federal top bracket is 20%. So that goes anywhere from 0 to 15 to 20. Most people on capital gains on the smaller end are at 15%. But when we're dealing with big properties, let's talk about 20%. So your total capital gains percentage is 33.3. Your total ordinary income is 50.3. Does anybody have any questions on what I've covered so far? All righty. That's probably a good sign, or I've put you all to sleep already, which is probably not a great sign. So that's your normal depreciation schedule. So let's go over here, right? I've got years 1 through 5. I'm going to assume I own it for a full 5 years and then I sell it. So my rent's 85,000 a year. It goes up by 3% a year. So in the last year, I'm at 95,000, which is pretty cool. And then that's my net rent after all of my cash expenses. And then I'm going to take my depreciation expense. So my taxable income is 72,000 and change. My actual cash income in my pocket before taxes is 85, but from the government's point of view, I only made 72,000 and change. I then pay my taxes, right? And my taxes are on this number. So the taxes are on the 72,000. It's ordinary income, right? So I'm saying it's at the 50.3. So my net income, which is that taxable income minus my taxes, is 35,000. Then I put back in what I saved from depreciation, right? Saved another 6,500 bucks. I got cash in pocket, 42,000 and change. I may have screwed that up a little bit, but let's keep going. In fact, I know I screwed that up a little bit, but that's all right. It's good enough for the discussion. So 18% of my cash in my pocket is actually because I'm doing depreciation. So I'm putting more cash in my pocket because of depreciation. When I send this spreadsheet out to everybody, I'll fix it. But I just did, I subtracted the wrong thing, but don't worry about it. It gets the point across. Let's talk about something called bonus depreciation. People have heard about cost segregation studies. I'm going to stop sharing for a second. Has everybody heard about a cost segregation study? Everybody know what that is?
Yep.
Okay. So
You went over that. You went over that in a previous call as well.
I did, absolutely. So I'm going to assume you guys know what it is, but I'm going to give a 12-second overview. You can either, when you do your depreciation schedule, you can just take the purchase price
Work email, no.
and do it for the 39 years, right? Hold on, I'm going to do a little mute there. You can either do the number divided by 39 years and that's what it is, equal amount every year, or you can go out and working with your accountant and a cost segregation specialist, you can get a study done that will break all of those improvements down based on some things are a 5-year shelf life, some of them are 7 years, 9, 10 years. So you can actually break out the various components of your building so that you can do something called bonus depreciation. Right now, bonus depreciation has come, it's on the schedule. It started at 100% bonus depreciation, went down 20% a year. We're currently at 40%. From what I've heard from the Trump administration, they're going to go back up to 100% bonus depreciation. So I'm using the 100% bonus depreciation now. So you can do it the normal way I just showed you, or you can get extra depreciation in the first few years. So I'm going to share that with you right now. So what bonus depreciation is telling me, I'm going to assume I went through and I found out that out of that $500 depreciable base, half of it, $250 or $250,000 qualifies for bonus depreciation. So I'm going to take that $250,000 write-off in year one, and then the other $250,000 I'm going to spread out over the other 39 years. So now I'm going to do, this is the normal depreciation. In the bonus depreciation schedule, I get rent. I get this write-off of 85, I get a write-off of 250,000. It may actually be more than my income. If you're a real estate professional, you can spread that out over your other income. So it's a nice way to actually save money on taxes. If you're not a real estate professional, your accountant will tell you the rules on how you can spread it out over future years. I'm going to assume these are all real estate folks that can write it off, or professional investors that can write it off. So I have 85,000. I would normally be paying taxes on my 85,000. I take my accelerated depreciation. This is an extreme example on purpose, by the way. I take my depreciation expense under that cost segregation study, and now my taxable income is actually a negative number. And I'm getting money back in taxes. I'm not getting it back on this deal, but I'm assuming I've got other income that I'm shielding from other, my normal 1099 income as a broker, my other investments, whatever. So I'm actually making money on this thing. I'm keeping the 85 grand and I'm getting another $82,000 in tax savings on other deals. So my depreciation savings is actually quite a bit. It's 125 grand. This cash in pocket number, I'm gonna delete that because that's the same mistake I made on the other deals, on the other spreadsheet. So I'm gonna leave that out of here. So in the first year, the increase for my cash in my pocket is actually exponential. So I didn't put a percentage to it, but in the other years, so that first year I depreciate 250,000. In the others, I'm still depreciating 6,410, which you'll notice is roughly half of that 12,000. So I took half of my depreciation as bonus in year one. The other half I'm still spreading out over 39 years, although there's other schedules you can use. I'm just trying to give you, 30,000 foot view examples of how this works. So if you're in the real estate business, or even if you're not and you take a loss carry forward, this bonus depreciation is pretty significant. It can change your entire tax profile, right? So you may invest in a property that puts cash in your pocket, but you don't pay taxes for 5 or 6 years. That's entirely possible if you know how to use accelerated depreciation schedules. So you own the property for 5 years, you're going to sell it. Now what? Let's talk about this for a second. Let's say I bought it for $1 million originally. I'm selling it for $1.3 million net. That's after my brokerage fees and all the other expenses of sale, the money that would normally come to me, right? And I'm not doing a 1031 exchange. Or I want to know what my cost savings are if I do a 1031. So my sale price is $1.3 million. Well, my capital gains is 300,000, right? I paid $1 million. I'm selling it for $1.3 million. 300,000 of that is capital gains. But we've already taken depreciation. This isn't that normal schedule. So we've got normal depreciation of 64,103. See how every year for 5 years, we took 12,821. If you add that all up, that's your 64,103. Well, now that I'm selling the property, the government says, hey man, I gave you a tax break for all those years. I want my money back. Well, that depreciation, it's called depreciation recapture. The government's recapturing it. That's taxed at your ordinary income rate. So remember back here, we were talking about what's my max ordinary income rate? Well, you can see 50.3% is higher than the 33.3%. So capital gains, you're paying this lower percentage tax rate. Depreciation recapture is done at ordinary income because you got an ordinary income write-off, you're getting an ordinary income tax. So here's my 1,000,003. I made 300,000. So my capital gains tax is 99,900. My depreciation recapture here is 32,244 bucks. So instead of putting 1,000,003 in my pocket, I'm putting 1,606. I'm sorry, 1,167,000 and change in my pocket. Okay. When we did the bonus depreciation, we took a heck of a lot more, right? If you look at this, we took a huge write-off year one. So if you go over here and you auto sum this for those years, we've taken $275,000 in depreciation. Here's what's kind of interesting. Let's say for whatever reason on the normal depreciation schedule, that's the one they use. Let's say I could have taken depreciation and I didn't take it. I think the IRS calculates it as if you had taken it and you pay taxes on it. So you should be taking depreciation every year. That's something you might want to double check with your accountant, but I remember hearing, Jonathan, do you know that one off the top of your head?
No, that particular nuance, I do not know, John.
So until you verify it, it's a rumor, but the rumor I'm hearing, which I think is probably more than a rumor, is if you don't take depreciation, the government will tax you on a sale as if you had. So you might be paying this depreciation recapture even if you didn't take it.
CI 104 and the CCIM curriculum discusses that.
Okay.
So talk to your CPA.
Oh, always talk to your CPA, but imagine paying taxes on a savings you never got. You might be a little irate. So in the ordinary path, right? We sell it, we have depreciation recapture. Right, we've taken 64,000 of depreciation. That costs us 32,000 at the closing table because we're paying the government. We get 1.67 million, right? 1.167 million. Let's say we took that accelerated depreciation, right? We were pretty psyched. We didn't pay taxes on 275,000 in income, right? We got that phantom write-off. We sell it for 1,000,003. We pay the same 99,900 in capital gains. Your depreciation recapture just jumped. Instead of being 32,244 bucks, you're now paying back $138,647. So you can see how the depreciation recapture tax number might be significantly higher than your capital gains exposure. Most people just look at the capital gains tax. They don't consider their depreciation recapture. And I have seen some horror shows come April 15th from people who didn't realize they were paying another couple of $100,000 in taxes they didn't think they were going to pay. So I was in a call a couple days ago with one of our brokers, had one of our clients, and we're talking about whether or not they should do a 1031. Because look, if you do a 1031, you don't pay any of these taxes, right? If you do a 1031 and you die and your kids get the tax, or whoever your heirs are, nobody gets the capital gains tax. It goes away forever. Nobody's ever paid it. Nobody pays the depreciation recapture. So in some situations, 1031 exchanges can be pretty good. So when I was talking to this gentleman about his 1031 or potential 1031 and whether he should do it, I said, okay, well, what's your capital gains exposure? And he told me the number. I said, what's your depreciation recapture exposure? He says, I don't know. I said, well, we should resume the call when you know those numbers. And he asked me why, and I'm going to give you my personal take on it. This was over $1 million, deal, over $1 million in cash, and he might have spent, I don't know, call it 100,000 in capital gains tax. Well, I personally would not do a 1031 exchange in that situation. In that situation, if I got $1 million coming back and I pay the taxes, I've got 900,000, but I'm not doing a 1031. I'm not trapped with all the rules of a 1031. I'm just paying the taxes. If my savings is $200, I'm absolutely doing a 1031. Between 100,000 and 200,000, I don't know, right? That's where the nuance comes in. So the answer in that situation on whether his taxes included depreciation recapture or not was critical, because it took it from an absolutely I wouldn't do it to I might do it to absolutely would do it. because this depreciation recapture number, especially over time, can be significantly higher than your capital gains number. I have done an awful lot of talking, 21 minutes to be exact. Does anybody have any questions?
So
Has
is
any-
there a way to avoid the recapture from bonus depreciation? Or are you stuck with that whether or not you did a cost seg?
Well, that's two questions, right? Because there are people who will do bonus depreciation without a cost seg. If the IRS ever comes a knocking, you're going to have a problem. But there are people, so you don't necessarily need a cost segregation study to do accelerated depreciation, but I would certainly recommend that you had it. If you have, the only thing the government's going to make sure that you did take is ordinary straight line depreciation. But if you haven't done bonus depreciation, then you didn't get the savings, you're not going to have to pay it back. If you
Okay.
did take the write-off, you're paying it back unless you do a
Sure.
1031, right?
And it
And then
costs you more to pay it back than it did than you got benefit up front. You just hopefully win on time value of money.
well, no, it should be about, if you're in the same tax bracket all the way through, it should be the same. Because let's say you're in a 40% bracket all the way through. I wrote off 250,000 in the 40% bracket over a few years. So I got that 40%. And then when I do
Yeah.
depreciation recapture, I'm paying it back at 40%. So I
Okay.
got
Yeah.
to use their money for free, right?
Okay.
But
Yeah, I got mixed up with the capital gains tax rate. You're getting hit at the front end by your ordinary income on the operations.
so yeah, so they balance the scales. If you're getting an ordinary income benefit, you're paying back in an ordinary income. If you're getting a capital gains type benefit, which is not in this example, you're paying back capital gains.
Gotcha.
But yeah, you get the use of their money for those years. The problem is this, that the big assumption is you're taking their money and you're investing it somewhere, right? Most people, when they get the money in their pocket, it's gone. Right. So if you're just going to spend it on things that aren't helping your life, you're better off not taking that accelerated depreciation. Um, if you're being, if you're thinking about it carefully, taking that accelerated depreciation tax savings it can be a great thing to do, and it can be pretty life changing.
Yeah, the one thing I would add is that you know, you see a lot of old partnerships where they've done depreciation of their basis down to zero. And when that occurs, it's especially problematic if they don't have a like kind exchange strategy because, the depreciation recapture is at ordinary income rates. And so when you do an analysis of somebody's exchange, you tend to look at both depreciation recapture as well as capital gains. And most people don't realize, okay, the depreciation recapture will actually occur if you don't exchange as part of a sale.
So I want to throw something really interesting at you guys. If you buy a condo, right? Because sometimes you're doing a 1031, you don't have any basis left, or not much, right? You've depreciated a lot of it. If you buy a condominium, it has no land, right? So if I change in this formula land to zero and improvements to 100%, right? I now have a depreciable base of $1 million on $1 million asset. I go over here and I do my accelerated depreciation. I'm taking a $500,000 write-off year one, right? Pretty interesting. I could be saving a couple $100,000. My return on that asset, I might make 85,000 in cash, which is 8.5%, and then get another 25% on tax savings because I'm a real estate professional or I have other real estate deals that I'm doing that I can match the write-off against that income. So we've worked with people who use condos as a strategy to increase their depreciable base, or if they have very little left in the way of depreciation in their 1031, they want something where 100% of the purchase price qualifies for depreciation, right? Because they're looking for tax shielding. So as you get kind of into the more interesting levels of investors that you're dealing with, or if you're kind of one of those more interesting investors dealing with these tax strategies, you start looking at how can I eke out. It's not just about the rent I'm getting, it's about the after tax money in my pocket. And if I'm a real estate professional, I could take a write off on this and apply it to gains on all sorts of things.
I like that part. Did not know that about condos. I have had clients tell me that they need to buy something this year for $400,000 or $300,000 of depreciation because their CPA told them they need this much depreciation.
And this is how
That's
we, yeah. So that's, by the way, that's Andy Crawford, who's one of our go-to finance guys. Um, Even though, we've got NEI Finance, but we do stuff together with Andy all the time. So he's taught me a few things on retirement account investing, which is saying something. Um, that's a neat trick. But we've got these condo accelerated depreciation strategies, which we've used that with the Fire Mesa and the Trinity projects, by the way, Andy. That's sort of why one of the reasons part of that exists. And
gotcha.
then, as far as taking write-offs on other types of income, the stuff we're doing in Santa Barbara is designed to, give that sort of write-off. So we get into that sort of tax strategy with people. We get into that sort of tax strategy with ourselves.
Makes sense.
Anybody else? By the way, I only slated this call for a half hour because depreciation is just not that interesting. It is. I love it, but I mean, there's not 2 hours worth of materials unless you get something really specific. That being said, we can go over it. But we've had a couple of questions come in. Does anybody else have anything they want to cover or any specific questions? I'll give you the last nugget of information. If you're representing a landlord who's doing a transaction and there's tenant improvements involved in that transaction, a couple of things have to be depreciated over the course of that lease, a couple of the expenses. Believe it or not, the leasing commission, they're paying the brokerage fee up front, but they're amortizing that out over the term of the lease. So they might write a check for the $100 for a 10-year lease, but every year they're only writing off $10. It's actually a little different. It's based on how your formula is. So be aware of that when you're talking to landlords. The other thing is the tenant improvements that are put into the space. They should have the contractor keeping track of all of the different items, because some of those items on a 10-year lease might be on the 5-year depreciation schedule, so they could get some benefit there. But the entire thing is not going to be on that 39-year schedule. It's going to have some things on that 39-year schedule, and the rest of the stuff is going to be depreciated, amortized over the length of that actual lease. So very specific tenant improvements that you don't think the next person's going to take, you depreciate those over the lease. Some of the improvements that you think would be useful, they improve the building, they'd be useful for the next tenant, you're depreciating those over 39 years. So when you're working with a landlord doing a complex build out for a tenant, it can get pretty interesting from a tax strategy point of view. And being able to offer advice on how to look at that is going to set you apart from the other guys. All right. Any call for questions? Guys, I'm going to circulate this call link. I'm also starting to put them up on a YouTube page. We have probably the worst production value of any videos out there, but I think the content's pretty good. Feel free to share the information with your clients. If you've got specific questions, please give me a call. And if they're over my skis, we have a couple of accelerated depreciation experts that we've hired for our own projects that we could get on the phone that could give us specific answers to your questions. So I really appreciate everybody taking the time. It's a Friday at 3. I'm sure you've got better stuff to do.
Appreciate
And
you taking the time.
thanks, Michael. It's by the way, nice to see you, brother.
You too. You too.
All right, guys.
This is informative.
Thank you. And look, you'd be shocked at how often this stuff will come up once you know about it. All of a sudden it comes up and a client wants to know about it, or you want to do it for your own investments. So we just want to keep giving you information that's actually useful.
I thought I knew it all, but I actually didn't know that residential was different than commercial. So apparently I did not know it all.
You got value out of the first minute, the other 29 minutes were you just paying for that.
Exactly.
All right.
Thank you.
Thanks, guys. Have a great
Thanks,
weekend.
John.
Hey, Carl.
Have a
You
good
got
one.
it.
Bye bye.
Thanks, John.